Welcome to TradeTheMBI.com. Hopefully everyone can hear me. This is going to be our indicator reference guide, and hopefully you had an opportunity to download the information from, and I'll go ahead and put the site up there. It was just simply Trade the MBIs, and we gave a special link, and you'll find it in the chat. And we'll go ahead and put that in there right now, and it will take you to this basic PowerPoint. But we're going to go ahead and go off of my traditional screen, and we'll just take it one step at a time. And if you have questions, please know that there's a little bit of a time lag between the sounds you hear in video as well as what I've already said it. So if you have questions while we're starting through it, please feel free to ask them. Also, I just wanted to let you know that this is basically the introduction to these indicators for a lot of people who are not familiar with them, and so we won't be getting into the extraordinary depth of some of them. We'll save that for the advanced version, and we'll go on from there. Alright, so what we're looking at here is the trend model, and basically what this one does is it simply colors the candles red or green based on an algorithm that determines whether or not trend is building and or growing. At one point I thought about creating them as a increasing color, but it's just simple to see them as red or green. And this was an important distinction to come up with, because once we were able to determine red and green trends in the market, then you're able to compare very specific readings, and that became very important in really helping to define the MBI and the GAM. And what we're looking at right here, white candle represents the MBI, and the yellow is the GAM. And the GAM stands for Gradient Algorithmic Multiplier, and the MBI is simply Morgan Buy Indicator from my last name. So good to see everybody coming in there. I'm seeing the names going through. Amy is on the moderator chat, so she'll be responding to you and your questions, and then she'll get them to me as we're proceeding. So what I wanted to point out with the MBIs, the GAMs, they were originally designed because in my decades of technical analysis, there were always areas where I could never figure out why a particular move was successful, not successful, and that led me down the road of, creating filters and algorithms that began to, dig deeper into some of these reasons. And so this is where we began to first get into the concepts of chaos and a little bit of these other expanded math theories. Now you'll find that the MBIs tend to show up nice little white candles, as you can see with the white arrows, at bottoms. There was a second element which turned out to be the GAM. Now the GAM often appears at points of extreme volatility, typically where people are mostly terrified to get into the market and are afraid that it's a falling knife setup. And while we expect increased volatility with the GAM, we still have the same expectation, and that typically was within 5 bars you would have a higher close, and those numbers were in the low 80% range. And we found that if you ended up with a higher higher open directly after an MBI or a GAM, those numbers moved into the high 80s. So it became very successful that way to use it. And then with the red trend, we're able to also look for discounts in general. And this is a popular theme that I talk about with our dot alerts as well. So that's was a very unique way of looking at the market from its basic standpoint. And then, for me, this was a breakthrough, the extreme histogram. Now this can be displayed like you're seeing here in a subgraph, or it can be put directly over price. I like it directly over price because for me you can remove price or leave price on there. And that is daunting to some people because a lot of people are used to channel lines in various directions, and with the extreme histogram, a lot of that is not necessary. And there's just a couple of basics with it. We have a red line, which lets us know when we've reached oversold, and that's at -60. This -45 line lets you also know that you're oversold, but that's typically between oversold and extreme oversold being the red line. And then what we want to do is look at these various setups and determine whether the market is overbought or oversold from moving down below these extremes to the opposite extreme, which is a positive, because this indicator, when I created it, I saw no mathematic reason why it should ever go positive, and yet here we see positive readings, and we found those to be very interesting, particularly when they show up. And let's go to the next slide here, and it's going to show us price with the extreme histogram overlaid, so it gets a little bit busy. Now, a couple elements that define overbought and oversold. We look at our extreme oversold as dipping below this red line. We look at oversold in general when we dip below the blue cyan line right here at negative 45. That becomes important as to which color the trend is. And particularly in red trend, you can capture some sizable downclines in general, but using this understanding of our extremes, we look first here at the blue boxes where we have positive extreme, and this is the market clearly overbought. Now, with most indicators, you get to a situation where you're up at the high end of a range, and it just kind of floats there, and it really becomes ineffective for gauging moves up and down. And so what this allows us to do with the extreme histogram is say, okay, we've got an extreme situation. We can utilize additional indicators, but it also becomes important when we're looking at unique setups. So like in this case where we go from red trend to green trend, and yes, we go to a positive extreme, we're not considering this overbought where most indicators would have gotten all the way to the peak of their readings, most of your typical bounded oscillators. And we know that typically 5 bars is usually where we want to then check the readings after we've gone from red trend to green trend. And we can see in this case, the market's not overbought. In fact, it's rather neutral. I mean, this middle range, anywhere from minus 10 to this minus 45 down here, is sort of just in between normal market behavior. Now you'll notice at the end of the chart here, we've gone positive extreme, but immediately, starting after that, that overbought eased. And it's just that dramatic to be able to see whether or not you're increasing your overbought and or reaching a situation where the ideal reversal setup here is a higher close on a lower extreme histogram that you would see over on the left hand side. And so in this particular middle range right here where we see a negative 8 reading, you're getting into an overbought every time you get inside of the negative 10 area. And that's typically when we start to look for any types of reversals. Also, we usually take that as an opportunity to start thinking, okay, we need to lighten our exposure to the upside. It's not that it can't continue, it's just that you want to be a little more cautious when you see those kind of readings. It becomes particularly daunting when you get deep red trend, you come up and you become overbought while still deep in a red trend. And that is something that throws people off. And I know I actually had this debate on StockTwits with Chartly. They put up the charts talking about the market being extremely overbought right over here when it just happened, and I'm looking at my extreme histogram saying no, the market is not overbought here. And this is where I caution some people who get a little anxious in some of the readings, but that's where I think the extreme histogram just one of the most effective tools I've ever seen at finding extreme overbought and oversold. So let's take a look at another little setup right here, and this you'll find on another page of our move, and we get into divergences, and we also want to compare. In this particular case, we can use price as an opportunity to say, okay, are my extreme histograms, now if I were looking at this and I had no price, I would be seeing that I have a higher extreme histogram reading, and yet I'm matching with my lower price. And those become excellent opportunities to take advantage of what should be pretty decent moves, because it's typically a market maker who has convinced everyone that we're about to break to new lows, and even some of the better ones like in number 2 here where we broke down to new lows on much higher extreme histogram, and this one in particular on number 2 being right at the negative 45, which becomes a bullish reversal setup. And we just look for that first higher extreme histogram reading, as the confirmation, and we're able to take advantage of that higher histogram reading. Now, whether you decide to have your histogram, if you have the indicators in a subgraph or directly over price, that's a personal preference. It doesn't make any difference how you see it. I find it convenient because when you put it over here, you can clearly see overbought has taken place here in this red trend, and you get a little bit of a retrace until it's eased itself out. And then we utilize some of our other indicators to continue with the trend move or not. Now, in number 3, we have a situation where we dipped below in green trend, and then it kind of converted to red trend. And in a very compressed move, we dipped back down, and again, you can take these smaller compressed moves, but what you're going to need is some additional indication when you're in this middle range, because while you dip down here below the negative 45 and you were still above extreme oversold, bullish within this setup, you're going to want confirmation on those readings moving higher, and that's easily provided with the other indicators. But going through and looking at the extreme histogram, understanding when you see these overbought conditions and how overbought can extend itself with green trend, and that becomes very powerful in looking for general setups with this. So, terrific indicator. Once entering a nice trade, I pretty much always wanted to create a situation where I had something that would give me a reasonable adaptive stop. And so the advanced baseline modifier became that version of it. And the way I created it was to reset itself after MBI or GAM showed up. Soon we're about to come out with part 2 for the advanced baseline modifier, where you'll be able to actually literally just put in a price number, and you can have the averages adapt to it. That way, if there's, for instance, a dot or one of those that pop up, you'll be able to adjust to those and then use them as a trail follower. For me, I typically look for breaches of this cyan line for very fast trades, and then we'll trade long above them and be out below it. And usually becomes fairly good. There are times where you're going to get into an extreme market move, and you'll be able to follow a trend nicely. Even when they're parabolic like these, you'll still be able to find really nice opportunities. And depending on your tolerance, some people who are longer swing traders, they'll want to follow the magenta. If you're a real quick hit looking for fast moves, you go with something that's a little bit smaller right here. Let me go to the next one, and we can take a look at a couple little setups. So we have our different speeds. You have your fast line, your mid speed, your slow for your magenta, and you can see them resetting at each time that the key signals come in. And it takes a few days after a particular move has happened, and the idea behind that is that we understood that within 5 periods, particularly for an MBI GAM, we were looking for a higher move, and it would wait for price to catch up to the expectation. And that expectation is important because it lets you not be fooled by general price gyration, because oftentimes MBIs, GAMs, we're going to come in at points where the market has started deceleration, and it looks as though price is going to continue to fall forever, and it doesn't, because it usually gets stopped by one of these setups. Moving on, we move into the expanded ratio histogram. And the expanded ratio histogram, probably one of the more complex indicators that you'll find. It's an oscillator in general. It also gives us an example of market flow, and whether or not the market is moving in a neutral or exaggerated state. And so while it's bound, appears to be bound top and bottom, there is no limit to its upside or downside. In certain chaotic events, you can have a broad range of readings from the expanded ratio histogram. So, but what it's really designed to give us is trend, direction, strength, and also a little bit of volatility thrown into there. It's kind of a multifaceted mix. This is the easiest way to kind of get a gauge for the expanded ratio histogram in this. I've always referred to it as a highway, and you have a lane, the top portion, another lane at the bottom portion. But then we get into off-road setups where we move past those lanes, and then we completely get off those freeways and move into new highways, which to me correlate into new directions. And then we can further isolate the market by saying, okay, if we have orange in advance of the color, then bulls are in charge. Yellow, bears are in charge. And then for the cyan, it becomes a market balance. And when we get into the more advanced features, we will add in the cyan angle to it because it gives us reference points for biosignals with it. So it becomes a rather clear idea if you stop looking at it just a bunch of squiggly lines crossing around. I often equated it to the little Frogger game, you know. You got to go from one side to the other with the cars traveling both directions. But the normal flow of the market is important, and to understand when the market is no longer at a normal flow becomes significant, because you'll get these periods where it stays beautifully within there, and then all of a sudden moves outside of it. And we'll move on to the next slide, and we begin to look at a little bit more of these ranges. And I think I have to slide back here to get into some of those. Okay, so this happened to be a range where trend had just turned green, and initially when we first see the move, the yellow is in the lead. Well, that's a negative, and the market moved down. But immediately after that, the orange, and it's a little difficult to see with the lines a little thicker, but I wanted to make the lines thicker so that they're visible to you. But the orange is clearly up on the top side, and it comes down, and the orange again, even on the dip. Now, this dip here let us know that we were, continuing a move in that new direction, and the orange continues to stay above yellow all the way through these continuations and peak moves. And so this gives you a broad sense of this trend capability as it slides all the way through. And it isn't until we get past this red line right here where the yellow reasserts itself and lets us know that the bears have regained control. So throughout all the squiggly, the most encouraging thing I would say when you're looking and you see an expanded ratio histogram, see which color is on top, and that'll give you an idea of that range, and also whether or not you've moved into these dramatic areas, because it often indicates the directional move. And in this particular case, the direction was going to continue higher, where some people might have thought, there was a decent sized gap down at this particular point, broke below some of those lows. You might think the market was going to be heading lower. This would have given you pause to say, no, it looks still positive, and you have a continuation. Now, likewise for that, we're going to want to look at the next slide, which would be bearish setup for the same. And that would be like right over here. Found a good combination of it. So this was kind of a fun one to look at, because even within either a bull move or a bear move, there's still points where the market will move up or down within that broader trend. And so this one reflects the bear dominance with the yellow line being directly above. And so what we can do is we can see that in this bear trend, sure, our trend model caught it early. We also knew it was going to be a pretty dramatic event. Look at the distance that these have spiked well off into a new direction before the market makes its eventual move. Now this bar right here looks to me like the 2010 flash crash setup. In this particular case, we were already short this setup before it took place, and that's fine. Now, what's interesting, and we'll get into in some of the more advanced features of it, is the distance between the two spaces, because it becomes an interesting anomaly, and this is why I pointed it out here with these blue ellipses. When we've dipped below here, and you can see that the bears are still in control, very easily in control, from this setup originally. And I remember when this actually happened, I mentioned to people it was going to take months to resolve this setup. And much like Apple, when it had its similar event, you have to be prepared for that kind of time that it's going to take. But within this, we look at a couple of key issues where you dip off this highway, and at times you'll get the move from either the orange or the yellow, but you don't get a corresponding comparison with the other. And those often become mini reversals within a downtrend and can often be played. This one popped up, it was a little early, came back again and gave it a second time, pretty close to the same value, because by the time you get the signal, your earliest entry would have been right over here, and then you get a secondary one right at the same spot. Convenient that a GAM came in at the same time. You're going to find this as you start going through all these indicators. You're going to get a series of signals that are all identical, and this is that ducks in a row that I refer to often. And you get a little mini bull run, and then obviously you'd be wanting to look at your extreme histogram to see if you've gotten overbought, and more likely than not it's going to show you you're probably a positive at this particular point. And I look for, bullish moves within a bear trend will be the yellow crossing below the cyan. And then we can get into the relationship of the cyan at a different time, but anytime you're over +2, you start to look for crossovers to the downside. It just becomes a unique little phenomenon, but that can be a very effective indicator and definitely worth having on your list to at least review. And this is where I'll not put every indicator on one chart, but have a series of them, and this is why in different posts I'll usually put up the relevant one. And then we move out to one of my favorites, the shakeout indicator. And the shakeout indicator was, in essence, my way of letting people know there are times when, yes, you can expect the market to continue in its direction, or that they're putting on a head fake, and you probably want to be prepared to think an alternative direction. This originally came from my work with MACD divergences, and trying to get a better gauge on how that was, and the limitations that you had with MACD, and that were just that it was a little bit slower, and I wanted to focus moving away from price and its concentration. So most of my indicators, other than the ABM, really try not to take price into account, and that's kind of unusual in most cases. But the shakeout indicator, it's simply these white histograms that are going up and down, bullish being above the zero line and bearish being below. You also get to points where you've got effectively a distribution of large buyers, and that when you get to a negative 12 range. And then likewise you'll see this yellow and purple line. The yellow is a warning line, lets you know that you're reaching a point where you're getting extended and you're going to need to see some serious continuation with it. When you reach the purple, you've pretty much eclipsed most any move that you can expect to go any further. Now that doesn't mean that you're not going to have a continuation of a run. It's more likely than not you usually get some type of a retrace for those, and then it's that setup again, whether it resets and you begin a new range, or whether or not it just continues a little bit more overbought, and then usually you end up with a much bigger decline when that takes place. Next slide, and we can go ahead and take a look at some of these. Alright, so here, perfect example of the histogram and what we look for. And in this particular case, we came into this situation where we were well over the purple line in these rectangle boxes, and you can see we had a series of highs, all kind of matching. You don't have to be exact, but the point being is that you have similar prices, so you should have a similar shakeout reading. And notice we had successively lower highs. And as these were happening, I was telling members when we were reviewing these at the time that, in fact, that was not a good setup, and that we had to be prepared. And so we started liquidating most of our long positions and bought puts into this setup as we prepared for an eventual decline. And this is the key: eventual decline. We had to wait for the signals of the shakeout to actually give it to us, and that typically comes in the form of a dip of the white histogram below our yellow. And you can see it happen in a couple of cases. It happened like literally immediately after this high setup right here. You pop back up again, but you notice that even with the same readings, you weren't getting the matching highs. So there was plenty of opportunity to get out, and the market's usually pretty forgiving in those particular cases. You're going to get less forgiving when you move into the second and third moves, it's going to be more abrupt because people are starting to catch on that, oh no, there's a problem and it's going to get worse. So here was another good one too. Lower shakeout histogram under the yellow line. And this is what I look for breakdowns. You'll see it was dramatic right here. It was dramatic on this one as well, where you're above this running yellow line, and then all of a sudden you dip below it. And it's particularly worse if you dip below both the yellow and the red. That becomes a compounded effect, and that usually leads to a little bit more. And that's when you then begin to start looking, well, do I have another buy signal coming up, and or is my trend about to change and, you know, go particularly negative on me? Let's move on to our next slide. So this shakeout represents that type of divergence that I was referring to, and this becomes very easy to see on your charts. And um, it's also one of those where, you know, there are different levels for what you really, depending on your style, need. If you're a more active day trader in that, you might need more of the ERH in that. But if you're more of a swing trader, something as simple as the shakeout makes it very easy and clean to go ahead and utilize. So here we have much lower price on this break of lows. Now, usually when there's a break of low, you'll get all these people doing Fibonacci sequences going to the downside and making all these, you know, horrible projections of, you know, how ugly it's about to get. And in this particular case, we can see just the opposite, where we were continuing with the down move, and then all of a sudden, you get MBI coming after again, and the higher histogram on the shakeout, and it moves inside the yellow line. And that becomes an extraordinarily strong buy. You had this huge day already, and you're thinking, okay, well, maybe it's just a bull trap, that, you know, it's just going to be a continuation bear flag, whatever other names that people want to come up with. This was clearly a strong setup, and responded likewise. And you can see the nice move back up from the shakeout indicator. So these types of divergence happen often, and they're definitely worth taking a look at. Doesn't always have to be that way. You can end up with, in this particular case, matching lows on matching readings, and still have an excellent move to the upside. Sometimes you're going to see with the MBI or GAM that if you don't get your move within the 5 periods, that all the way up to 15 periods you maintain your 80% likelihood of a close above. And the outside, between 15 and 28 days or periods, depending on the time frame that you're looking at, the numbers stayed the same. So it was always my opinion, after 15, if you hadn't received additional signals or whatever, you know, it's a diminishing return concept, in the sense that you get the same probability of you're still going to finish over, but you're going to be waiting another 15 periods. But I love this shakeout setup. It is worth taking on a regular basis, all the time. So now we move on to our power momentum. Now, power momentum 1 and 2, these are very fast moving, a little bit more unique math concepts. We're trying to determine when there's an irregularity in the readings that are happening for market internals, and this is designed to give us a little bit faster heads up. When I'm talking about fast, I mean if you were looking at this from an intraday chart, you could have just a few period move, and literally your buy and sell signal would take place within that. You can also end up having a situation where it just begins to give you an idea of the overall balance between the market, who's really ahead. It's irrespective of price. It really has no impact whatsoever as to what price is doing. It's about giving you a concept of where price is leading to go to, and where the pressures are. Are the pressures to the upside or to the downside? And so the easiest way to look at our power momentum, we have two. Power momentum 1 is a cyan, yellow, double combination here. These lines represent when the cyan is above, you have bears pretty much in control, and when blue is above, you've got the bulls in control. And this histogram becomes interesting because what we're looking for is um, typically a move down in the histogram, and then the cyan taking over. That's the beginning of your start of a reversal, and then you would look for that to continue its trend. And so that gives you that earliest warning. We also look at the relationship between the distance of the yellow to the cyan, and we look for it to narrow, because that narrowing from a yellow standpoint means that bears are getting a little weaker, and the emergence of bulls coming back into the decline means that you finally started to see buyers, well, right about this setup right here, as it went positive. And then in Power Momentum 2, we're going to be looking at the relationship between two pairs of lines. The pairs are the dark cyan and the green, and the magenta and the white. And we're just going to be simply looking for crossovers within those two setups. So let's move on and get a little bit deeper into what those setups are, and we can take a look at some of them. So from our Power Mo, the yellow horizontal, what I've done here is I've just scrolled through general range of the histogram, and it was right about this 15 level became sort of a minimal peak, and then your extremes usually topped out right around this 22. And if we scroll back in time, you can do the same, and I recommend you do this with a typical chart, and it kind of gives you an idea of when you can sort of look for a peak of a move, and then you really want to start paying attention to that relationship of the ratio right here. As you can see, the bulls were really strong, well above the yellow, and all of a sudden, boom, it changed right here. And then it flipped, and that corresponded to right up here. And then you had a nice little bear run. Wasn't much because you were still in green trend, and decent strength within the setup, but it was an early heads up to a tiny correction in this particular case. And as you came down to the peak, you can see that you've already moved down into a nice trough. And then it turned around where the bulls, once again, regained control by moving to the top side of the histogram. And that produced a nice run that was actually very extended. And you can see it running out of steam. And this is literally how I want you to think of it. You can literally see them losing the battle as more and more shorts become emboldened as it reaches the peak. And then by the time we reached right here, bears had already taken over. And that continued that downtrend going through. So that becomes really a fast-acting way to see it. And you can play the minutia of every single day, but it's more effective when you're looking at it from a little bit more of a broader swing, where you've seen a pivot in the overall setup. And so when you're seeing this pop up on charts on StockTwits, that's what you kind of want to be looking for. Are you seeing the pivot there? You see a strong power move at the beginning of the pivot where the cyan is really strong above the bears. That lets you know that there's really strong, you'll often hear the term breadth when they're referring to, strength of a move, and that clearly defines that breadth. In our next one, this is where chaos, and this is one of the newer elements. I had not planned on really putting this indicator out for people on that, because it really does get quite complicated in some of its aspects. But I've tried to break out some of the easier components here that are just pretty simple. And if you ever see this one pop up on a chart, just a couple of things I want you to be looking for. We're looking for crossovers of the white and the magenta for buy and sell signals. Alright, so for instance, when we have, like here, there is a crossover of the white below the magenta. That's usually a negative and going to result in lower price, particularly after it's come from a nice rising peak. And from the opposite side, when you dip below, and there's only one horizontal line right here, and you'll see it in red up at the top, it's zero. When the magenta and white dip below that zero, that's an extreme oversold setup from a subset algorithm, and usually results in a pretty strong advance, and particularly if it comes off of a chaotic event, because in this particular case, the cyan, and if I were to click this for you, you would see the reading of it is a plus 1.618, which is a golden ratio number. It's not supposed to go negative, because the green is the negative, or its inverse. And so when you get this polarity change where they've flipped, in this case it did a double. I mean, it was below, then it popped back up. Um, what you want to look for is, okay, what is my relationship between my magenta lines? In this particular case, I'm below the zero, so that's a positive regardless there. Here, you've got well above in this particular case, but your white's moving below and crossing above, and then it crossed above in this one. Give you a brief move down, but also return right back up to the upside of it. So this is where this will become a little bit more specific to each stock, and so you'll want to go back and look at specific chaos events within each security, because some of them will react a little bit differently, and you definitely want to tie in the relationship between the magenta and white to those. But in general, if we were just looking at this white and magenta, you would have the general crossover. Now, some people, and rightly so, ask, well, what is a chaotic event? When we're parsing the data sets, um, they're usually pretty consistent. And then all of a sudden, you'll get a dynamic change, both either in their rate, the configuration. I refer to it as a resonance, because what happens is these computer algorithms tend to work in a frequency, and I don't want to get too complicated with it, but in general, it becomes abnormal, and you'll get these dramatic spikes, and the amplitude of the spike has a direct bearing on what your expectation is. Now, the event can be in place, excuse me for hitting the mic there, and because it gets kind of excited, I want to move my hands around when I'm thinking about this, because it could take a few days, or it could be immediately. So you've got to be prepared when you see this kind of skyrocket. You want to be prepared for it instantaneously, but it could still resolve itself in a broader context over a little bit more time. In this case, you saw this dramatic one, and it's not a coincidence that basically what we were seeing is they began to unload a significant amount of shares on this rise coming up, and once you get the sell signal right there, it created a much broader sell-off. And it's kind of a precursor to those kind of things, and it also represents, when you see a situation like that, it just causes you to want to pay more attention to what's going on from your general readings, because something unusual is taking place. Now, a bear run would be typically when the yellow is over the cyan. So when you see yellow popped up right here, you're looking for lower price. And then what you want to see is that the distance of that yellow to the cyan really shrink. And right here it turned over, and then it began a new cycle to the upside as this moved higher. So that's and this is the interesting thing about markets. It's not always consistent. You can get a couple of days of yellow, and then all of a sudden it turns around. And depending on where you're at within your general trend move, that's where you see certain red days will still have a nice pop, but they end up resolving to the same direction. And but for your power mo and the chaotic events, definitely you want to pay attention to what it's done in the past. You also want to be looking at where you are in this general cycle, and you can see right here at the end of the chart, okay, that happens to be on the 18th, you've had a nice cycle up. You're about to get a crossover, but you'll notice here we've now seen 1, 2, 3 lower humps on 3 rising moves in price. Does that tell you that something potentially is setting up? Yeah. Is it a little early? Yeah, a little premature, because what you really want to start to see will be the magenta begin to roll over, and that becomes your advantage when you're seeing it that way. And so when you're looking at power mode charts that pop up on StockTwits and that, be looking for those little crossover kind of waves, and you can see that the market's in pretty much a nice resonance, even pattern, not really doing real chaotic thing, anything bizarre like that. In future studies, you'll be able to go back and look at the relationship between higher peaks and lower peaks. Definitely has a value. And in the super advanced course, we will get into the nuances of the green and dark cyan of the Power Mode 2, even within their much smaller moves related to the red line, because we have even more to go over with those. But from a simple standpoint, if you see this on a chart, you'll be able to understand it. You'll be able to refer to this and kind of say, okay, I see that crossover from above down below as a sell signal, and if I'm also seeing it down here below my zero line and below the green, not even supposed to get down to those levels, you know you've gotten a nice little extreme move. I know I use the word extreme too much, but some of these are very extreme. You'll get a lot of simple views that, you know, the market goes in nice little waves, and it just doesn't seem to be the case. The market really performs violent moves, and I think this is more of an advent of the new computer age, because you have to jump on a move very early or it's over before you even have a chance to see it. Now here's an indicator we don't put up a whole lot, the MRS. That stands for the Morgan Reverse Signal. And this was an early indicator that I had put together. It was a range-bound oscillator, similar to a relative strength. And what it did was I wanted to create different speed levels. And so each of the different colors represents a different speed for the market, where you have your green being the fastest, the magenta in between, and the yellow the slowest. And the limitation for it was when we got into what most people refer to as overbought, and this is a lot of what you see in regular oscillators. And I think if we go to our next page, you can see when you get into these extreme areas, in this particular case at 75 is the red line, becomes ineffective. A lot of times with the signals, there are unique setups, but very few that you can really take advantage of. But this becomes very cool because I'll use it as a confirmation, particularly at the bottom of setups. You can see down here, green comes below everything and then crosses back above. That's a bullish setup, even though price still corrected lower after the little bit of the pop. You were on a much higher reading, and again, those kinds of divergences you'll hear people talk about. Getting into extreme situations where you've already moved up to the top side of this range and your trend is potentially moved green, or you're in a little bit of a up cycle, you can get these pops where you move below key levels, like in this case it's the 45 midpoint, where it'll dip down, but you have to get a corresponding dip to your magenta to give you a read, and the first buy for it is on the first uptick coming back. You can see I marked one right here where it didn't happen, where the orange just continued, I mean not the orange, but the magenta here continued its cascade lower. Even though you had the dip and the pop, you did not get it from your magenta like you're seeing with these isolated points, and that becomes important to be able to see the difference between the overall setups. And you can see here at the very end, you have one of those exact dips and a confirmed move. So the expectation is that you should see a higher move going into Tuesday for the start of this, though you are pretty much capping out, so how much time is left? Probably not a lot, but it's worth noting. So that's typically what to look for in the Morgan reverse signal, and I tend to look for it more on the downside, simply because it's a little bit more effective. And when we get to the overbought, this is where the extreme histogram becomes your friend, and you definitely want to utilize the extreme histogram when you're in those peak areas. So here, what I'm showing for the MRS is the rectangle, and this is that overbought, and it just becomes a muddled mess. And this is, I think you'll see it a lot with stochastics and well, relative strength and all these. They get up into these peak areas, and the signals just become incoherent, and that's why I moved to boundless oscillators with our shakeout and the extreme histogram, so that there's no limit to where they go, and we were able to put them at least in a visual form that at least it's not crippling. But for the MRS, simply looking for breakdowns at that 75 is also an effective way to see when the market was about to do more significant breakdown, and that particularly a little bit lagging, I thought, and this is another reason why I moved into some of these more advanced ones, because you need to get a little bit more ahead with the computers that are trading these days. And so there's nothing wrong with the original indicators, it's just they're behind a little bit. And And that's just the advent of, faster cars, faster technology. Buy-sell ranges. They're similar concept to Bollinger Bands, in the sense that they're looking for an upper and lower range. And the concept being is if you dip to the lower side of the band, that would be your buy, and when you get to the top one, it becomes the sell signal. It kind of gives you loosely an idea of the direction things are heading, but it can be kind of misleading. And I think sort of like Bollinger Bands are, it looks good after it's drawn, a little bit more difficult to trade it from a practical aspect, because fine, you dip down to the bottom here, it would have you sell there. Well, the next day you're expecting that range to be the same range, and you're often not going to find that to be entirely possible. I put it down because it does give you a relative idea of where you should be thinking of either exiting a move or entering in. If you get the indicators, you just highlight over it, and it'll give you the buy range of 139. Would suggest that you sell at 141 there, and that's how simple that works. Nice to have it. It was a adjunct to the price oscillator, and the price oscillator was kind of helped in a way to define momentum with price. And what you end up with are a couple of key areas on here. Price represented in your white line, the momentum of moves represented in the green. And this little magenta line becomes key. It's at 24. In a certain setup, we'll go over in a second, will be what I call the 20-20. But when you get over 70, you have a bullish setup. When the price weight reading is between 40, 69, you're kind of in a neutral no man's land. And that's where you typically, whatever the trend is, it's going to stay the same. And then when you get below that 40, you've reached bearish territory, and you've got to be looking for an extended down move. And then likewise for our momentum, we look for dips below this negative 50, and that becomes key reversal points. In between those areas, really don't pay a whole lot of attention to it, because it's just going to be a gyration. You're not going to get as much from it. So it's the extremes that become relevant. But again, it's capped at 100 at the top side for the price, and 0 at the bottom. And then the momentum, it can go down to negative 100 and all the way up to 100. So if we go ahead and take a look at some key points, it makes it very clear looking at this chart exactly what you want to be looking for when it comes to our price oscillator. So I refer to key events, and you'll see it up here. The blue rectangle is my 20-20, and I use 20-20 even though the numbers are not 20-20. It's 24 because 20-20 is, everybody can remember that. It sounds familiar. And literally what it is when you've had a nice dip in your momentum and you come back up, and you've had both your price as well as the momentum dip, and they in synchrony move up above this magenta line on the 20-20, and it signals that move. And we saw this happen right at the start of the year. We were expecting it even before, when we saw the momentum move, because we look for these momentum dips below the negative 50, and I've marked them here, and you can watch the pivots. And do they correspond with key moments of MBIs and GAMs? A lot of times they do, and that's an added bonus. And so you can't ignore this setup. Now, you'll see when those who watch the nightly reports from Trade the MBI, we go over this as a separate chart as we're scrolling through when we do our daily market analysis, because it's important to notice these types of setups, because they become significant bounce points. And typically when we're looking at a reading like a 20-20, we're usually projecting that within the next 3 days we should have that move transpire. And it's sort of a forward-looking, it's attempting to predict a direction, not specifically an amount that move will go. And so a nice indicator. I like it. I've always used it, and continue to point it out. And definitely with this kind of visual, you can always come back to this detail and see these setups. Because that chart, you won't see me put up on StockTwits, and that's typically something that's for our Trade the MBI members when they're looking at it. And then here you go. This is where it all began, really, the MBI indicator. Because I became frustrated after using technical analysis for so long that by the time 2004 and 5 came around, the signals, were still winning in the 50%, but they weren't making as much money, and oftentimes, if you didn't have the right stops, they were losing money. And I did these videos on our website, the trust and trade, the MACDs, the stochastics, and found that while you can win well over 50% of the time, near 60% was the typical range, they were money losers if you followed them as they were designed to be traded. And that became bothersome for me, and so the MBI indicator literally was designed to try and capture that mode. And so literally what I was looking for were moments, again, the same as the MRS, and you can find these matching confluences that would take place. And the easiest concept was then to try and color a candle that would give us that representation. And even within the MBI, what I was looking for were key areas of oversold. I wanted to see like a situation where we dip below our negative move, and then when you had a pop back up, though, I found that you became less reliable when you moved all the way to the top end of the range. And again, this is where it became a problem, because you had a top end of the range, and we weren't able to push back beyond that, because you would get to it and people would think, oh, I've gone too far. And as we've seen in the market, that really isn't the case. And these become unique little setups for the crossover. The green represents a much faster setup of data read versus the slower line. And I'm looking for both the change in direction or a stop in the momentum, like a flattening, that then wants to turn around and has a crossover at that particular point. And what you'll often find, and is particularly a bullish setup, is when you get your green coming back up and it comes to your line and then pivots back up. The difficulty is you can't predict what the likelihood of that is. You can see it after the fact, but you're not going to know it ahead of time. And so this is where the MBI indicator became very effective at the bottom side of it, and again, the upside a little bit less useful. So then we move on to another one that causes a lot of consternation for people. It's an effective indicator, and I want people to understand it. And hopefully this little series will give a general sense of it, because when you see this one, you definitely want to look at it, because it's going to give you some valuable information. So without using traditional volume, and that really nowadays can be distorted so easily with algorithms, I wanted to create a setup that would give you an idea of what we could see behind the scenes as bull behavior versus bear behavior. And without going into the algorithm, that's generally what we're depicting here. So when you see the white, that's representing what our bulls are doing and how much activity we're seeing from them. The red histograms are the bears and how much we're seeing from them. Now, above this zero line, bulls are in charge. Below it, bears are in charge. Simple enough. Okay? So just looking at that, you can almost depict a trend in general by just seeing, okay, overall, who's more in control over this, period right here? Well, bears, definitely. And you had bulls trying to make an attack, but not very successful, as bears just overwhelmed them. And then here you can see that bulls have really pretty much taken advantage of the situation. So now, let's get into some of the complexities. And oh my goodness, well, that looks really busy, doesn't it? But what we want to look for in our up-down power is just a relationship. And if we start with our blue, we can see bulls being in charge on the upside, fine. So what we want to calculate, though, is a relationship between the two lines, particularly when they get close together. You can eyeball it and see that, in this particular case, bulls have this well in hand, bears are nowhere to be found in it. The simple calculation, and I marked it right here, with the most recent reading in the green, and that takes this bar into account. And literally what we're doing is we're taking the 120 and dividing it by the 324, and in this particular case, gives us a 37%. So at this particular point in the market, we're not looking at bears as being really all that excited about attacking the setup, because what we're really trying to see is if we get over to 69%, that would let us know that bulls have actually lost grip on the market, and that bears are actually leading. And in that particular case, we can expect that we would have a reversal. At this particular point, no. So it looks clear to the upside based on that relationship. And the key points become, you get a pretty consistent through this entire up move. We have not seen bears do anything that would suggest that they had control or were even attempting to make a serious attempt to move price lower. I mean, literally, very little resistance here at all. Let's move on to a next one. I'm going to scroll back a little bit, I think, here. I wanted to show some unique setups within up-down power so that you can get an idea of what kind of setups to be looking for, because there are multiple concepts within this. And here we can see that with our green and our dark cyan, we have setups where we've dipped down, and I've done the calculations for you based on what the white reading was, the red reading, and we ended up with a 69% ratio, bulls to bears. The difference being between these two colored bars and this one right here is the relationship of the bears. And you can see the histogram declining right here, and for the first time it turns to the upside. That is your first buy signal from there. We saw it clearly that bulls were very interested in these setups where you had, well, in this case, you ended up with more bulls than bears in this particular spot, but yet price continued to fall. But we were looking for the first tick up in our bear histogram. Same thing here, continuing down. This is our first tick up in the bear histogram. Here, you ended up with the same ratio, 89%, but it continued to decline. And it wasn't until that first move up with the histogram that you ended up with a little bit of peak, obviously got overbought extraordinarily quickly and reverted back the other direction. But that will give you an idea of what to look for. You don't want to jump the shark just because you have a 69% reading. That's not enough. You need to actually have the direction moving up and going in the right way, and that will help clarify you. Move on to our next one, because we also discuss a secondary setup right here. And this is another question that comes with can't quite see that at the bottom, can we? I need to do a real quick adjustment for that. We'll go to scaling. I'm going to give myself some more room at the bottom. There we go. Just like that. Alright, so here's what I refer to as a bear trap. And kind of a unique setup. Literally what we have is a nice uptrend, and then all of a sudden we get a little dip. And people are starting to talk about the sky is falling at this particular point when these happen. And what you're looking for is bears overshoot themselves, move to the negative side, short heavily, but notice how the bull power, not even close to being down at the bottom or even flipping to the opposite direction. And then immediately you have a higher histogram read, and bears are trapped. And oftentimes this will create a nice little volatile pop to the upside because they're caught and there's no room for them. In this particular case, you came down, you still stayed positive, boom, higher histogram reading, meaning more bulls jumping into the setup, and then all of a sudden, shorts realize the jig is up and they're nailed. And you'll see this pattern quite regularly, and definitely worth looking for, because what they've done is pretty much got themselves into a nightmare scenario where they think that the lows are likely to be broken. And in this particular case, you went and you took out all these stops, so it looked like there was a complete breakdown, but clearly there was no breakdown, because the bulls never lost control of the setup at all. They were literally creating the trap. And so you'll see this kind of divergence. Now this is one of those where, no, you can't really take the minus versus the plus. What you're going to look for is your first pivot back up on your histogram for the bulls, and it didn't even matter. You could have a situation where the bulls increase and bears increase. And that's even more volatile for bears when that particular case happens. So that's a good one to pay attention to for a bear trap. Always effective, and that's just kind of a basic read. Now we have the ratio hawk. Now, we're not seeing any ratio hawks there, so I have to slide back to a point where we ended up with a series of ratio hawks. So in this particular case, we're looking at ratio hawk, which is the green dot, and a red dot short. And so what I've done was we took a combination of a series of algorithms, a lot of the indicators that create them, and we combine them into specific setups that would create effectively a signal without having to do all the work of going through a chart. So this would just pop up as a dot, and you would know that, okay, I've already looked through the shakeout indicator. I've already gone through up-down power and the various things to give a complete picture. Now, ratio hawks starting to be an up move. The red dot was specifically for extreme overbought, looking for a short. The only difference with those is I typically will look at the extreme histogram when I get a red dot, because sometimes you can get a continuation move, and I will also check my up-down power for those that want to check it, because if I'm still getting continued large gaps of cyan above the yellow, then I'm going to wait a little bit to get a little bit higher price. Still effective where it is. I mean, upwards of 78% win rate for the red dot short, but those can be improved when utilizing some of these simple techniques, as well as in green trend looking for discounts, so wanting to take the high-low range and looking for a higher price. But you can see here, this red dot short resolves itself. Interestingly enough, you end up with a green dot buy before it resolves itself. These conflicts happen quite frequently, and this is where utilizing your shakeout, looking for the next reverse point up, because potentially you might need to cover before your full short, particularly if it's in green trend, but you would be able to see that within your shakeout overall. And so this is where utilizing, those traditional indicators with these dots can be extraordinary in utilizing. Now you'll look and you'll see that every single one of these was successful in their moves to the upside, as well as that one to the downside. Not always going to be the case, but still very effective in combining all of those setups. Further, in creating those same kind of ones, and you're familiar with these, catfish, it's a cyan dot, the extreme fractal, which is the red dot below price, as opposed to the red dot above, and the halibut. There's a little green one, dark green right there with the arrow. And what you'll get for these is sometimes a series. And you'll see a cyan dot, a red dot, you may even see an orange dot, and they can all develop in a row. And they're all distinct configurations, so when you see them all together, it's a much more powerful combination. And this is something you'll see on a lot of the charts, because I'll put these up constantly, both from a daily, and we'll watch them, sometimes move a little lower, and people will say, oh, you're wrong, and then all of a sudden, boom, turns around, goes up, and they fill their targets. And again, this is where in red trend, we definitely look for our discounts, and in green trend, you're not necessarily looking for those unless it's a short signal, but clearly very effective with these. Looking at this time period, this is the most recent time period, so we looked at ratio hawks from a little bit earlier, and here you have your extreme fractals and catfish. And the idea behind the catfish, bottom feeder, so it's looking for the bottoms of moves. The halibut, typically a little bit higher up in that water column, and so those signals tend to come a little bit further up. And that's typically what you'll see in the differential for those dots popping up. From a target standpoint, pretty consistent. The white dot's going to appear at the top, and that white dot target is the close plus the ATR, and it's a 14-period ATR, which just stands for average true range, how much a stock typically goes up or down over a given period. and we multiply that by 1.236. Yeah, it's a 23% roughly on top of the gain, and the stop being the ATR times 2, and you may have to adjust that stop level depending on the volatility of a stock. Some of them will trade in a pretty broad range. You may need a little more room. The ATR is designed to accommodate that, but I always recommend that people take a look at those, because with these dots, uh, you can adjust them. You can adjust your stop. You can adjust your profit target for comfort. I recommend the 1.2 because the testing that we've done on these with the 78+% win rate and 2+ profit factor, just taking them in general regardless of trend, pretty effective. You don't want to go too much lower from a profit standpoint, because if you go 1 to 2, you're going to win 66% of the time just to break even. So having that extra advantage really makes it clear. And you can see, well, all these orange dots were winners as they showed up here. And, they took, well, in the green trend, you're going to take less heat, particularly when it comes off an MBI. And I think if we probably put the catfish back up there, I think that those all appeared pretty close to these same times. And it's no coincidence that it's finding bottoms, because these are the fractal setups that pretty much these computer programs love and repeat over and over again. And then in our last combination of fractals, we end up with our pink dot, the yellow dot, and the gray dot. Now, the yellow dot used to be referred to when you would click it as a series. I did go ahead and change the name back to yellow dot, just to make it easier because it matches the color. Why not? And pink dot, clearly visible as a pink dot. And your gray dots, we'll go over those in a moment as a special configuration. But the yellow dots, like a GAM, are going to come up at a bit more volatile periods. Oftentimes where people think that the market is about to fall down, collapse even further, and a breakdown. In fact, this yellow dot, very close. The low stop on there for it was 134.54, and we can see where the low was 134.70. Came very close to that, and then boom, they added into that setup. So they were happy with that overall move, and then massive gap up takes you above where both their entries were. So dramatic move on that particular setup. Likewise here, and again, same kind of setup with the GAM, but resolves itself usually after pretty big gaps. And this was interesting because if we look at our date right there, this is during the whole debt talks, and you can see that we ended up with the buyers there. We also saw that we had orange dot at the same time, so we were getting a series of buys, specifically all at that same time when everyone thought there was no deal on that. So interesting that computers were doing something very different than what everything on the news and people were talking about. And I think that becomes important because nothing I do has any impact or relation to news. And you're going to have to get that way if you want to be effective. Otherwise, you'll get whipsawed around trying to guess what the reaction to things is going to be. Now, here's the gray dot, and the initial concept for the gray dot was simply to find a setup where, typically in green trend, I wanted to be able to find spots where I could buy at a discount. Because oftentimes you would get an extended move and you would want to look for, okay, well, when is it safe to get in? And better yet, when is it better to sell now and try and find a little bit lower price to get back in, just to lock up some gains? And the gray dot became a very good read at that, and it was originally designed just to test the low of the bar. What we find, though, is with the gray dot, if it comes particularly after a red dot short, oftentimes you get the red dot short, you get a couple moves up, and you get a gray dot. That becomes a very strong one for your target to the downside for your red dot. So I tend to look for those after I've had a red dot and I'm getting a nice move up, looking for my discount, and then a gray dot comes in. That's when I know that it's safe to go ahead and attack a little bit more. And over here, what we've got, we're basically the original retests. And again, in this case, going back, the dot setup here is the ATR. And so the ATR, again, you can find that anywhere. And I wanted something that was something consistent that anyone could find. And like even when I do my dot alerts, you get your email and it says, you know, the ATR. You can go on any freestockcharts.com, any regular platform, and they're all going to have an average true range. And the standard is 14 period ATR. And they'll give you a number. And for instance, even if I were able to go to here, I believe I have ATR. I do. So I tend to put it right over price. And in this particular case, we just highlight over it, and it says the ATR for this gray dot was 1.26. So $1.26 for that ATR. Well, what that would typically do is take the close and multiply it, that ATR of 1.2 times an additional 1.2, and that's where it projects that down target. So pretty basic math. Is just a couple of calculations. I mean, you have to take that 1.26 and multiply it by 1.236. Interesting, that's all right around the same number, but and that's how it works. And what I'm looking for usually is the low retest, and depending on what my readings are, would determine whether or not I would just take that sale if I were shorting and cover at that point, or stick with it if I was getting a decay in like my shakeout reading. And that's how I would then look for capturing a bigger move on the downside. In these most recent ones, all I was looking for was just a retest of the lows, not looking for the targets, because we had such bullish readings overall. And you can see that we ended up with another one, but again, they fulfilled the request of moving down to the lows. And if I'm still getting buy signals, I use that to go ahead and become a new buy entry. And then you can see the most recent one just came in, but we also know that we're getting bullish readings right now, so it may take a little bit more of a day or two before we get a response from that particular gray dot. And so at the end of the day, I wanted to create a program that would incorporate the concept of that ATR, because the ATR is relevant for, you know, generally how the market's moving, and I wanted to be able to trade it with what our expectation of a trend move was. And in this particular case, we end up with, this is what members who have the indicators get, is a daily trend trade, and this is on futures. Currently, it trades green trend, goes long, and looks for a user-defined percentage of the ATR. And so in this particular case, it got in at the open right here, which was 1478, and is looking for a portion of the given ATR for the day. And I would have to put the ATR on here for us to go ahead and look and see how much that ATR is overall. 13 points. Before that, it was 15 points. So it would be taking it off the 15-point ATR, which was the day before. Let me put it up here so you can see it in the window. So there you see at the very bottom says ATR. And so it's looking for a portion of that ATR to capture each day to the upside for green trend and to the downside overall. And so this was a nice little program. We can run our performances on it, but those can get skewed looking at it overall. The general concept is you're not looking to kill the market, you're just looking for a general move. And then I moved that on to going from futures to the MBI Opus for stocks. Now the MBI Opus is 24 plus unique setups within the algorithms that break the market up into very specific elements and then find areas to exploit. And again, it utilizes a similar concept, looking for an upside target, and they can be optimized for individual stocks, and you really need to, because when I designed the MBI Opus, it was designed for indexes, your NASDAQ, your S&P 500, the Dow, and within that, I then allowed for certain inputs to be put into the programs, and you can go through and literally fine-tune. You can't change the general concepts. What you can do is alter some of the general characteristics of a stock and a little bit tighter entries as far as that goes. And we've even had some members go through and do some of the optimization work, and those are on the website under the MBI Opus programs. And you can go through and see what those configurations are. And I recommend that people do advancements. Now with also the Power Mo, we're going to have a complete change in all of these, because the added aspect of the power momentum, number 2 in that, is going to allow us to create a whole nother series of setups within the MBI Opus. And so what you're looking at right here happens to be MBI Opus NASDAQ. In fact, the MBI Opus NASDAQ just completed 2 trades from the Iron Hawk. If I slide this over, you can go ahead and see them. I gotta get it to grip price, it's not gonna cooperate. Oh well. What were the entries? 27, 28. I'll broaden my screen a little bit and you'll be able to see it that way. 27.28 and 27.14, and then the target 27.44.50 for that particular one. So that's what the MBI Opus futures for the NASDAQ were doing. Now we can look at a performance report for that particular setup, and it's fairly decent. 77% almost, 2.45 profit factor. And for profit factor definition, we can look right here. It's where you're taking your gross profit, gross loss. Anything over 1 means you have a net gain. So basically winning just almost 2.5 times the losses. And then I look at the performance graph. I want to see a nice equity curve that doesn't have too many dramatic dips and gyrations. You'll see some that will go up and down, up and down, up and down, and that's just too extreme for my preferences. And then the granddaddy of them all, the MBI Opus. This is the culmination of everything that all these indicators were ultimately leading to. I wanted a program that we could trade very effectively and capture fairly decent moves with relatively modest risk profile. And this is what the MBI Opus has produced. The 80% win rate, you're going to vary. I'm not too concerned whether it's 78% to 82. One point it was 83. Had a couple of losses right there at the end of the year because of the liquidity drop. And this is where futures were a little different than the overall market. We were long the SSO, the 2 times ETF for the S&P during this particular setup, and futures dipped dramatically, but the market ended up opening higher than that overall setup, so we ended up with a nice move from there. The computer setup, not quite as good. We ended up entering a little bit lower because we knew we were in red trend and we wanted more of a discount. And then they did this little phony drop thing that pretty much just cleared out stops. They love doing those kinds of things. It did give a brand new buy at the beginning of the year, and that shot up very effectively. So that's the culmination of what it does. And in general, we can go back and actually, one other item I like to point out on that, and I put this on the PDF for everyone to look at. If you ever want to go back, if anything was too quick, you can go back and look at these charts, and that's all on our webpage. And if I put up Trade the MBI, you've also seen the link for it, and Amy can put that one up again if you missed it from before. It's on our website, so you can go ahead and take a look. But nice equity curves, and from my standpoint, I also like to look at consecutive losses, because there will be times where you get a couple losses in a row, and you want to know what is my typical number of losses to look at. And from my view, I sometimes see those losses as opportunities to take advantage of price moves. And so here you can see consecutive winners over losers, dramatic. Back on the overall price summary, we can go here, maximum consecutive winning trades in a row, 35, maximum losers, 4. So when you lose 2 in a row, at that particular point, you're starting to think, okay, I might even actually increase um, my exposure because the likelihood of continuing past that diminishes as you get closer to 3 or 4. So those become variety of different money management aspects, and this is why even with the dot alerts, in that I always recommend people divide their positions into 3 separate categories of entries so that they're able to leg in, because I've never been a fan of just jumping in 100% to something. You always want to be careful about your setups and utilize effective money management that way. And the fortunate thing is we get so many signals. There's no need to rush and jump into it, and you can take your time. And then when you have something that gives you this degree of confidence with this particular win rate, and that you can feel comfortable. And trading is about feeling comfortable. It's about being okay with what's going on. And when you get that degree of comfort, and that comes from having reliable indicators and setups, they're never going to be 100%. Nothing is. But they're going to give you some pretty good reliability. And what you're going to be seeing coming out next will be this. This is the MBI Opus 2. So this becomes phase 2 of the compilation. And so this is the whole point is I never stop. I'm always looking for moving higher and getting closer to that ultimate goal. And what MBI Opus 2 begins to do is it begins to separate the individual buy and sells, where MBI Opus 1 will take an aggregate of 2 entries and combine them for the 1 profit target. This one literally seeks to take each separate entry as a separate value, and combined into MBI Opus 2 is also going to be the additional work I've done with the chaos theory and the strings, utilizing our power mo setups, and I'm actually going to be combining those retroactively into the dots as well. So eventually they will all be utilizing each of these indicators. And so the idea was to give you a basic reference for how everything is and the genesis of my thinking and the progression with the indicators. And so hopefully when you see them now, you'll have a little bit more expanded understanding that this isn't just some guesswork, that a lot of thought and care has gone into it, and hopefully it will improve your trading, not just giving you an additional standpoint of confidence, but a framework to understand the market and some of the unique things that go on within it. And we can get into debates of what manipulation and that is, but some of the bigger players with large amounts of money can move the market in directions they want. Whether you call that manipulation or not, that's relative. There are also competing players against them, but whoever's bigger is going to come out ahead. And in this particular case, in the recent times, since, well, last year about this time, the biggest player in the game right now is the Federal Reserve. And the billions of dollars every month they're pouring into mortgage-backed securities and where they're going to force things. So I'm seeing more and more with these kind of intrusions into the free markets, that regular indicators are going to become even less and less effective, and that these fractal setups and understanding the subset algorithms are going to be more important. It's just my view. I know a lot of people still don't have that same concept, but that's okay. I'm going to continue to be out there pointing it out, and hopefully you'll find some merit in what I'm talking about, and I will be continually available to help people navigate these interesting times. So with that, I'm going to sign off. A different version of this is probably what's going to appear on YouTube and that, where I'm just going through the actual PowerPoint PDF and that. So thank you all for coming. I will stay on the live chat even though the broadcast will end. So if there are additional questions, I can always go back through some of those. And what I want to do now is let's talk about who wins our free memberships. So Amy, do you have your little drawing together for that? you know what Amy is going to do? She is going to put down the names on there for those, because the girls are going to draw the names out of the hat right now. And look for it on the chat room here, because you will see if you were a winner. As always, though, everyone, take care, and we will talk again soon.